Right now, Novonix Ltd is trading at $77 a staggering surge of more than 27% on the day. While screens everywhere are just flashing that bright green number, the real story isn't just the percentage gain. The critical detail is the underlying order book and the volume pattern. What we're seeing isn't just a frenzy of small-scale retail buys on platforms like the Robinhood app. The data indicates a significant number of large block trades being executed, suggesting that institutional desks, perhaps those managed under banners like Fidelity Wealth Management, are actively re-evaluating and potentially accumulating positions based on the latest developments. This isn't just noise, it's a significant shift in how the more substantial market participants view the company's immediate prospects, moving it from a long-term speculative hold to an active, event-driven trade. For what feels like an eternity, the prevailing narrative around Novonix has been one of immense potential, weighed down by the heavy burden of commercialization and scale-up. Investors, whether they are using SoFi Invest for their online investing or a more traditional individual brokerage account, have been told a consistent story. Novonix holds the key to better, longer-lasting, and more efficient batteries with its proprietary synthetic graphite anode material. The expectation was that this superior technology would inevitably lead to massive supply contracts with the world's leading battery and electric vehicle manufacturers. Yet, for months, the stock price has reflected the reality of a pre-production company burning through capital. The chart has been a painful sight for many, a slow grind downwards that tested the conviction of even the most ardent believers. The market's expectation was a straight line to success, but the reality has been a winding road filled with operational hurdles and funding concerns, causing many to question if the promised future would ever arrive. Today's explosive move, however, forces us to challenge that pessimistic reality. But to simply accept this price surge as the final validation of the company's promise would be a significant analytical error. The deeper truth is that while today's catalyst, let's say a conditional commitment for a major government loan or a landmark offtake agreement, is a massive de-risking event, it also marks the beginning of an entirely new and more intense period of scrutiny. The market is cheering the reduction of financial or commercial risk, but it is simultaneously placing an enormous magnifying glass on the company's ability to execute. The pressure is no longer on signing a deal, it's on delivering metric tons of material on schedule and on budget. This is where many emerging technology companies falter. People managing their own portfolios, whether through an intelligent portfolio service or actively trading on a platform like Interactive Brokers, need to understand this distinction. The game hasn't been won, the rules have just changed. Looking at the intraday trading action, the volume is already multiple times its 30-day average. This isn't a slow drift up, it's an aggressive, high-conviction move. We're seeing short sellers likely being forced to cover their positions, which adds fuel to the fire and can exaggerate the upward price swing. This is a classic short squeeze scenario layered on top of fundamentally positive news. For someone new to online investment, this kind of volatility can be intoxicating, but it's also where disciplined strategy is essential. It's one thing to see your SoFi investing account flash green, it's another to understand the forces driving it. This is why many people seek investment help or use tools from established investing sites. The current price action is a battleground between algorithmic traders capitalizing momentum, long-term investors recalculating their valuation models, and shorts running for the exits. Unlike the more predictable, macro-driven movements you might see in a behemoth like Apple stock or the AI narrative driving NVIDIA stock, this is a very company-specific binary event playing out in real time. For those less familiar with the company, let's briefly establish what Novonix actually does. It operates in a few key areas, all centered around lithium-ion battery technology. Their flagship product is PUREgraphite, a high-performance synthetic graphite anode material. The main value proposition is that their material can lead to longer battery life cycles, which is a critical factor for both electric vehicles and large-scale energy storage systems. They've developed a proprietary furnace technology that they claim is cleaner and more efficient than traditional methods, primarily based in China. The company also has a cell testing services division, which provides crucial data and analysis to battery makers, giving them unique insights into the industry's direction. Their past performance has been a roller coaster. The stock saw a spectacular run-up during the EV boom, fueled by high expectations, only to see a dramatic correction as the market grew impatient with the slow pace of commercialization and the broader downturn in speculative growth stocks. That painful history is what makes today's reaction so pronounced. It's a release of pent-up hope and a potential reversal of a long-term downtrend. This brings us to a fundamental question about the entire supply chain. Comment below with your perspective. Do you believe North American and European efforts to build a self-reliant battery material supply chain can realistically compete on cost with established Asian producers within the next decade? This is the core issue that will determine the long-term success of companies like Novonix. Looking forward, we must consider the diverging paths from here. The bullish scenario is that today's news is the first domino to fall. This validation allows the company to secure more favorable financing, accelerate the construction and commissioning of their production facilities, and sign additional offtake agreements. In this future, Novonix becomes a key node in the North American battery supply chain, a critical supplier to the titans of the automotive industry. The stock price would, in this case, be seen as starting a new sustainable uptrend. Investors who bought in through their Fidelity brokerage or Robinhood stock trading accounts during the downturn would be handsomely rewarded. The conversation would shift from survival to growth, similar to the path taken by companies like Tesla stock in its earlier, more volatile days. However, the bearish scenario cannot be ignored. The reality of industrial scale-up is notoriously difficult. A company can have the best technology in the lab, but face crippling setbacks on the factory floor. Delays, cost overruns, and quality control issues could plague their expansion. Competitors, not standing still, could announce their own advancements or price their products more aggressively. Furthermore, the macroeconomic environment remains a significant headwind. If demand for electric vehicles slows down due to economic pressure, the anticipated demand for battery materials could be pushed further out. In that case, today's spike could be a temporary reprieve, a bull trap before the stock resumes a downward trajectory as the company continues to burn capital without generating significant revenue. Users of sophisticated platforms like Interactive Brokers Trading are undoubtedly running models on cash burn rates and potential future dilution from capital raises. These are the risks that don't appear in the celebratory headlines. In the end, the story of Novonix today is a perfect illustration of the tension between market expectation and operational reality. The market is forward-looking, and it has just priced in a much brighter future based on today's news. The expectation is that the biggest hurdles have been cleared. The reality is that the nature of the hurdles has simply changed, shifting from commercial and financial to logistical and operational. The surge to 77 cents is the market's vote of confidence, but the company must now earn that valuation by executing flawlessly. The path forward requires a transition from being a company of promise to a company of production. For investors, the key is to look past the euphoria of a 27% gain and focus on the coming quarters of execution, because that is where the long-term value will truly be determined. The content shared on this channel is for educational and informational purposes only. It should not be considered as financial, investment, or legal advice. Always do your own research or consult a qualified financial advisor before making any investment decisions. If you found this video helpful, don't forget to like, comment, and share, and subscribe for more finance insights.